So in the previous video, we were talking about how the whole financial system is kind of grinding to a halt right now with the credit crunch and the fallen angels. And now it looks like we might be going into a national quarantine with the markets getting shut down. Possibly, that's not confirmed. But yeah, not fun stuff. But the really crazy thing is how the market is getting all screwed up. Because one of the effects has been all these assets, right, that are supposed to be uncorrelated, they're all moving together now. Gold, Bitcoin, stocks, bonds, real estate, they're all going down. So in this video, we're gonna go over those correlations because I know some of you have been asking for that. And I'm also gonna go over what to do to stay safe when all these assets are falling. And before we get started, for the last time, All Stars open, closing tonight. A lot of people are in already and I'm excited to work with everyone. But yeah, last chance today, link down below in the description and comments, check it out. All right, so let's go over this article from Of Dollars and Data, which is a great site that puts together a bunch of data and talks about it, which is what we're gonna do. So you know, with correlations during normal times without panic, the riskier assets usually have a positive return to other riskier assets to kind of move together. And riskier assets are like stocks, that's what we're considering here. And then the less risky assets have a positive correlation with other less risky assets, so like bonds with bonds. And the riskier would be like US stocks with international stocks. But between the two, between like stocks and bonds and risky and non-risky assets, and it's not non-risky, it's less risky, but they generally show little to no return correlation with one another. So they don't move the same, they don't even affect each other. Now that statement I don't completely agree with because, you know, we always talk about the rotation between stocks and bonds. But for our purposes right now and what we're about to go over, let's assume that's true. So this right here is what correlations look like in normal times. This is between 2014 and 17, which were calm markets. So you can see all these different asset classes, and the red lines means there's a positive correlation between their returns. And the thicker the red line means the more positively correlated they are. So like the S&P 500 has a correlation to US REITs, so like real estate. If one goes up, the other one usually goes up. But notice there are no lines from these risky assets, which include these international stocks and emerging markets, to these other types of assets like gold, municipal bonds, treasuries, or US corporate bonds. These are all less risky assets, right? And all the bonds have that positive correlation too. So it's what we explained before. So like I said, during this time period, 14 through 17, there were no major market crises. Risky assets are positively correlated and less risky are correlated too, but no strong relationship between the two. Now let's look at their correlation during some of the roughest times. This is the most volatile 2 months in the 2008 crisis right here. You can see right here, all these risky assets, the stocks and real estate, they got more correlated. These lines got thicker. Look at that, like little licorices. I just want to eat them. And remember, the red are positive correlations, the red licorice. I actually don't even like licorice. It's like eating plastic. It's like you can eat licorice or you can eat a plastic straw. At least if you eat the straw, you're like helping the environment, right? I don't get it. But anyway, the red licorice is, you know, positive correlation. And the blue licorice is the negative correlation, meaning that when one goes up, like stocks, the other one goes down, like bonds. So if you could imagine in 2008, if stocks were falling, bonds were going up, the treasuries. But you'll also see that the correlation between these safer assets, they went away, you know, less little red lines between them. So that's what happens in a crisis. So again, here, the positive correlations between the risky assets get stronger, but there's also a negative correlation between these risky assets and the safer ones. This is basically what the flight to safety is. So everyone starts selling their risky positions and they buy the less risky ones. They get rid of their stocks and they go into bonds. This is what makes correlations go to 1, which you've probably heard about, right? This happens in a crisis. All the risky assets start acting the same because money is pulled out of all of them. And like I said, these lines got a little thicker, right? Now let's look at what happens. Now this is what has happened with our coronavirus crash. Look at these lines, super thick, thicky thick. How's that song go? She ain't fat, bruh. Nah, she just a little thick. Man, this is what happens when you get quarantined and don't see any people. You just start looking at lines and thinking, oh, what's going on, line? How'd you get so straight? What are those dimensions? How many pixels are you carrying? I wouldn't even call you a red. I would call you burgundy. I would love to make your straight line a curve. You know what I'm talking about? Yeah, you know what I'm talking about. Okay, I'm done. Maybe. We'll see what happens after this video. But check it out. The correlations between the risky assets like became even stronger because the line's thicker, as I fully described. But everything else got looped in too. Now all of a sudden, all the less risky assets are correlated with each other, and they're positively correlated with the risky assets. Remember, these lines were blue before. Here, I'll go back to the other picture. See, you lost correlation with these guys over here, and then treasuries became negatively correlated to all the risky stocks. And remember, this was in the 2008 crisis. And now everything's moving together, all red. I kind of felt like an optometrist there. Clearer or blurrier? Well, this is clearly or worse. That's a stretch right there. But yeah, the correlations all jacked up. Just another symptom from the market breaking down from a structural level. Like, this isn't supposed to happen. So while the correlations between the risky assets are strong, as expected, there's an unexpected positive correlation between the risky assets and the US municipal bonds, and no strong negative correlation between the risky assets and US treasuries. The lack of negative correlation on that graph is concerning about this crisis. But it's also very recent, because if you remember, see, this blue line is treasuries and this orange line is stocks. Before this point, this March 9th where it's marking it, they were negatively correlated. Stocks were dropping, bonds were going up. We had that historic bond move, right? But then all of a sudden, bonds started crashing along with stocks. And that was after the Fed said that they were going to buy a bunch of bonds. It was crazy. You know, they were going to cut rates. Bonds should have went up. But no, everything started going down. So what's that mean then? What's it mean when the long-term US treasuries are becoming correlated with the S&P 500? Now, we don't know for sure because there's not enough data yet, but it suggests that investors are cashing out entirely. They're saying, screw the bonds, let's just move into cash. And that's why everything seems so correlated now, why individual stocks are moving with their stock indices like never before. All the risky assets are moving together, and even bond assets are falling too. In a few weeks, we'll actually be able to get data to see exactly what's happening, but yeah, the whole cash withdrawal looks like that's what's going on. So here's the thing that a lot of investors don't realize, but is true. Cash is a position, and it needs to be treated like one. It's a very important position, as you're seeing right now. See, a majority of investors, if they're in cash during the good times, they start feeling antsy because no one wants to sit on the sidelines and not make money. You start feeling that FOMO, like you're missing out on returns you want to deploy, which is why you know all the quotes from like Buffett about being super patient and sitting on the sidelines. He's good at what he does because he can do that for so long. He's very patient, but most of us want action. But the thing is, what's the safest asset right now that's giving you the best return? It's cash, because everything else is correlated and it's all going down. So if you're in cash and you avoided this recent market drop, you're beating the general market by 27% right now. That's huge, because the market dropped 27%, right? And that's just from making zero gains and just sitting in cash. And take a look at this recent spike in the US dollar. So it turns out that cash is really the only asset that is moving up. So right now with my All-Stars momentum system, it's an equity system, right? It trades stocks. But right now it's in 60% cash. So I'm just sitting and waiting. And that's what I love about it, especially compared to other momentum systems. Because the All-Star system, it's not going to keep investing and ride the market lower. Instead, it's going to cash out when the momentum turns negative, and it treats that cash as a position. So if I look at my portfolio, I'm 40% equities, 60% cash. Other momentum systems, they never get into cash. They just keep investing on the way up, but then on the way down too. And that takes a significant toll on returns, as you can imagine. And I know I've talked about it so many times, but I'm going to talk about it again because right now is the perfect example. Because if you're able to cut this tail risk that we're having right now, this 30% drop, this quarantine, this shutdown, all this craziness, your returns over a set of years, say 10 years, are going to be so much better than another investor who was not able to manage their risk and cut this tail end event. Like, this is the equity curve of the NASDAQ All-Stars versus the NASDAQ. See how much space there is and why there's such a big difference? It's because the All-Stars is so focused on continuously cutting off that downside. And every time you do, your compounding is just going to be that much stronger. And it pays off every year. It's just math. Like, if you go back to 2008, the All-Stars, during that crisis, it lost 7% that year. So to get back from that 7% loss to break even, it took a 7.5% gain. Now the NASDAQ itself was down 31% that year. For the NASDAQ to get back to break even, it would take a 45% gain. So obviously, which takes longer? The NASDAQ. The All-Stars is way ahead at that point. It's much easier to make 7.5% in the market than 45%. And when you can cut those big losses, like I said before, you're protecting your compounding. So like right now, the All-Stars model is break even with the market being down 27%. And now we have all this cash, all this dry powder just sitting there. So we're just waiting for the market to turn around again so we can deploy it. And the only time we're going to do that is when cash isn't the best asset to hold anymore. All that dry powder that we now have is the power of proper risk management. Now I got to be straight with you. I'm not expecting my system to pinpoint this the exact bottom in this market. The next time we're going to take a shot at the market is in April 1st. That's when our rotation period begins. Is the market going to turn around by then? No one knows. There's too much uncertainty. So it could very well be that I get into the market April 1st and I get smacked. Market drops another 20%. I don't know what exactly is going to happen. But the thing that I do know for sure is that I got that risk management in place so that I could weather that storm. And if the market keeps dropping, I'm going to keep rotating back into cash, the safest asset. And this is not like the first time it's happened to me. I think I made a video about this before, but it was February of 2018, right before the massive drop in the market. I put a bunch of money into the All-Stars, added a bunch of money, and that was right at the top, right where the market turned around and all my stops got hit, and I was like, man. And it was a tough period for me, but I kept executing, and by the end of it, I was up way more than before. Because again, I didn't know the market was going to drop just then, but I did feel confident in my risk management and the system that's been back tested. So it wasn't a surprise that it worked out after that rough period. System isn't predicting the future, it's just playing the probabilities. We need to be realistic about that, which is again why I'm not worried going into the coming weeks. At least in terms of the stock market, I am worried for the sick people because it's not good. And that's the downside case too. When we're running probabilities at macro ops, there is also a case that the market rebounds really fast. And if that happens, well then we're in great shape with the All-Stars. Either way, right now the market is so low, it's a great time to get prepped with a system like this. Great time to sign up and be fully ready when the market eventually does turn, whether it's next week or next month, who knows. And I've been getting a lot of questions about this all week, and yes, the system is very easy to use. It was built that way on purpose. It's like an iPhone, you know. An iPhone is really easy to use, but at the same time, it's a super powerful computer. Same with the All-Stars. It's easy to use for beginners, but it's a professional grade system. And the nice thing is the performance guarantees. So if the All-Stars model isn't positive with your year of being a member, then you can request your next year free. It closes tonight, check it out. I'm telling you, it's real nice having a back-tested system in your corner as a tool to use in these markets. Link down below in the description and comments, and it'll take you to this page where I'll explain a lot more. Click that, I'll see you there, and don't forget to subscribe to this channel and hit that notification bell. That way you get email notifications of our next videos. We're gonna keep tracking this market mess. So subscribe, and I'll see you in the next video. Stay fallible out there. Bye.